preferred equity risky? Well, it depends on where you lie in the capital stack. In today's video, I'm going to talk a little bit about what preferred equity is, and then I'm going to talk about where it lies in the capital stack and where it's actually riskier for you if you are in an investment like that. I'm going to tell you what exactly you should pay attention to when you're looking at an offering and when you're asking due diligence questions. All right, guys, welcome back to the channel. I'm Dr. Johnny Walker, aka Jonathan Withanachi. I'm a veteran endodontist that now practices at an ideal part-time schedule. And I'm also a 3C1 real estate fund manager that has helped dozens and dozens start their passive investment in real estate. And I've made it our career mission to help 1,000 dentists achieve true financial freedom through passive investment. Our capital firm is best in class. We have robust pipeline of deal flow, and we have the best due diligence in the entire industry when it comes to retail investments. We have a collective group of fund managers that leverage centuries of real estate investment experience so that we can provide the best due diligence, protect our investors, as well as deliver exceptional returns. If you want to learn more about our investment opportunities or join our investment club, go to our website. It's in the description below. All right, let's get into today's video. Start with, what is a capital stack? I actually did a whole video on capital stacks, but go back and find that video if you want to learn more about that. But very simple capital stack is how the money that you bought an investment property, where that money came from. So in a very simple real estate investment, you have debt and you have equity. The lowest part of the capital stack is debt, and then the top part is equity. If you have a property, 70% loan would be 70% debt, and then 30% of the capital stack is equity. And that's how you bought the property. The debt was from a bank. You borrowed money from a lender, 70%. The other 30% came from investors, from the sponsor, and it came from capital on the top. So debt, and the lower you are on the capital stack, the lower the risk, because the first proceeds coming out of that property that you bought goes to debt first, right? So the terms of the debt have to be met, which might be a monthly mortgage payment, before equity gets a piece of it. So the first proceeds is going to debt, therefore debt gets paid first, therefore debt is inherently lower risk. Equity, it gets paid second. Only if there's money or proceeds left after you've made your debt obligations does equity get paid. Well, that's a simple capital stack. Now there's another component that you can add into this capital stack called preferred equity. And preferred equity goes in between debt and equity. Now a capital stack in that same deal, we might have still 70% loan from the bank, but then we have 10% of the capital comes from preferred equity, and the remaining 20% comes from common equity. Now that slice of preferred equity means that they get paid next after debt is paid. Somebody investing in a preferred equity class share has lower risk than somebody in common equity or somebody higher than them or above them in the capital stack. If you're a common equity investor and there was no preferred equity in the beginning, now your risk has gone up because preferred equity has to get paid first. But there's a flip side to that. Because of their preferred status, meaning they get paid preferentially first, they also take a lower return. So it costs the sponsor less money when they have preferred equity because they might say, hey, you're going to get a straight 10% return with no percentage of upside. But since you're lower on the capital stack, you're also more likely to make sure that you achieve your 10% return. So somebody investing in that would say, hey, look, I know I'm getting a little bit lower return, but it's a lot lower risk, and I'm willing to do that. That preferred equity will take 10%. Now, if that deal was projected to return 16%, for example, to equity, before, say the preferred equity there's no preferred equity. If you were targeted, hey, look, with your percentage of returns, you're going to make about 16% per year on this deal. But now you add in that preferred equity, and you're not paying them 16%, which you're projecting that you're going to make, but you're only going to pay them 10%. So that leaves that additional 6% that they're not getting. And that goes into the general pool. So now common equity gets a percentage of that upside also, right? Of that unused upside, right? Because they're not getting it on the preferred equity side. That means that it goes towards common equity. And common equity will actually get a higher rate of return if there's preferred equity. So instead of 16%, they might be getting 17.5% because there's a preferred equity status. So there's two sides of the coin. Those common equity, if you include preferred equity, common equity has higher risk, but it also has higher return. My point is, I'm not saying that you shouldn't do a deal if there's preferred equity, and I'm going to give you a real life example. We closed on a 300 unit property in Houston, Texas we invested with a sponsor. It was a $35 million property. This was in 2021. $35 million, I believe $22 million was going to come from the bank. And with the remaining, I believe it was about 15 million or so. Don't get mad if my math isn't exactly right. But around 15 million would come from equity. Now, we were going to invest in the deal. We're like, hey, look, the numbers look great. You guys are buying at an incredible price. There's a tremendous opportunity. It looks like there's lots of profit to be made in this deal. We're excited to invest in this deal. And out of that 15 million, 6 million is going to be coming from a private equity company in the form of a preferred return. Now, one way to look at it is for us is like, hey, look, this strengthens our resolve that our decision that this investment is actually a great deal. Because now this private equity company also, with their hundreds of analysts and all of these people that are doing all the underwriting, with all of their professional staff, they're also taking a big chunk of this deal. They're willing to put $6 million of capital at risk. So that means to us, like, hey, look, this is a good deal. That means we're in a good deal. If these smart people are private equity companies investing in this deal, that's a good sign for us too. Well, yes, it is. But you got to also take that with a grain of layer of, well, my risk also goes up too if there's preferred equity involved, right? Because they're going to get their return first. And you as common equity will only get paid if debt and then the preferred equity is paid. So your risk goes up too. So that's one thing that you should always consider when you're looking at a passive investment. Is there a preferred equity component to it? This is something you can ask in your due diligence. And then you can make a calculated risk analysis and decision for yourself. Everybody's risk tolerance is a little bit different. Now, I want to talk about another thing that preferred equity has become very popular now in present market times, because we are in an unprecedented time where we saw interest rates go up 450 basis points, right? And there's a lot of distress in the multifamily, especially if operators bought deals in 2020, 2021 with floating rate debt. If the debt was floating and the interest rates went up, their mortgages have doubled and tripled, and they're like, hey, look, we ran out of money. We're running out of cash. We need more money. Otherwise, this deal is going to go under. Now, a lot of them have gone and done capital calls. Now, capital call is where, again, I did a video about what is a capital call. A capital call is like if you had debt and equity and they're running out of money, then these operators might go back to the equity investors and say, hey, look, can you kick in another 25%? We need to raise funds in order to prevent this deal from going into foreclosure. We might lose the entire deal. Now, investors are going to have the choice of saying, yes, we're going to put some more money in this, or they're going to say, hey, look, I'm not going to put more good money after bad. I'm already at risk of losing this money. I don't want to keep putting more money into it. And if that operator isn't able to raise the required funds to save this deal, so they can execute the business plan, keep driving the income, and that way they can pay the increased debt payments, and they can hopefully hold on until interest rates go down, then you might have, if they don't get the money from capital call and they're trying to prevent this foreclosure, they may open up a preferred equity position. Invest in this deal and you're going to get a big chunk of the profits, and you're going to get a disproportionate return because you're helping us save this deal. And they're called rescue funds. There's funds that are just waiting for guys to come and beg them for money so that they can take over deals and get incredible terms and make incredible profits. So when that happens, right, where they go in and bring in preferred equity, and whether it's legal or not for them to bring preferred equity into the deal depends completely on the operating agreement, right, that you sign at the beginning. The wording will define, hey, in the event that the capital call, we're not able to raise the capital, we can bring in preferred equity. This has to be defined there. So this is something that you might look at on the front end going into the deal, right? There's something to consider. What happens in the event that funds are needed? Now, if they have the ability to make this preferred equity share, they bring in more capital, they shore up their operations, they're able to drive the income, and the deal doesn't make a ton of profit. It's a marginal profit. They just barely scrape and exit. If there isn't that much profit to be returned, the debt will be paid off first, and the next part or group or party that will be paid off is the preferred equity. Once preferred equity is paid off, there may be no money left over, and common equity is wiped out. Right? Might be just that you might get a return of capital, but you don't make any returns, and in some cases you will lose all of your capital, but the deal will still move forward. And common equity gets wiped out by preferred equity. So in that case, preferred equity is very risky if you're a common equity member. These are things for you to consider. If you have any questions, drop them in the comments below. I know this is really going into the weeds a little bit, but very relevant in today's environment. And we're seeing a lot of this stuff happening. So it's paramount to kind of understand this so that we can avoid, prevent, mitigate risk by understanding this nuance. All right, guys, hope that helps. Smash the like button if you got any value from this. To keep your information going and keep the bank accounts growing, click on the next video. I'll see you next time. I'm Dr. Johnny Walker. Peace.